Good morning, Nick Edmond here from VolumeProfileTrader.com on May 13th, Mother's Day. So happy Mother's Day to all the mothers out there. As far as the market goes, to be honest, nothing really has changed. I thought I expressed my views, let's see, on Thursday night's video, and which is I think you can buy the market a little bit lower from here. And yesterday's price action, which was looked like a little bit of short covering in the morning, ended up being a great selling opportunity for a trade. Actually, Friday was a pretty good trading day, intraday for the S&Ps. So I think that if you're a longer term trader, as far as holds of say anywhere from 1 month to 9 months, depending on the price action, I think that you can buy stocks at a lower price, and I don't think it's much lower than here, but I do think there's a possibility for a continuation to the downside, and if we do see it, I would expect to see it this week. So you look at the S&P, didn't make a new low, just hanging in there. The Dow, actually, I believe it was positive on the day. It's at the bottom end of the range. Theoretically, and I guess this goes for everything, every time it's been to the bottom end of this range, it's visited, say, 13,200, which is good for about 400 Dow points. Is this time different? I tend to think so. However, when I look at the Dow and when I look at companies within the Dow, I'm most intrigued by those companies versus a company in the S&P 500, excuse me, or the Nasdaq 100. And I just feel that the Dow, those companies, that's not a bad place to be in the market. One thing to say about the Nasdaq is, though I think the possibility for more downside is probably likely, it continues to stabilize around this support. So just watch it, and we may have a trade back to the upside, but I'd like to think that the upside is limited on any market, any risk-on type of market, that is. And if you look at something like the dollar appears to be breaking out. Now, I understand, and you can really go back to the end of last year. Every time the dollar has been north of 80, it's really right to be a seller. But at the same time, if you're looking at these higher lows here, we're starting to bounce, momentum's starting to catch up, and then you look at something like the euro, which is breaking down from this triangle. You could even draw a resistance line going back from the end of last year. Kind of looks like the inverse of the dollar. It sure looks like the euro is trying to go into the mid 120s, and that's something to be aware of. That's something to be careful of. Like the Australian dollar, this is falling out of bed. There's probably no reason to jump on this train. Canadian dollar, looks like it, just based off of Friday's action, it's trying to balance, it's trying to hold here. But it does look like, let's look at the Japanese yen. The Japanese yen, what this looks like to me is a big, and just because I'm curious, I'm going to do the Fibonacci's. We'll do it based off of the actual high. Yeah, we're at a 50% retracement from this big downfall. And what I would expect is some type of selling pressure around here. We'll see. But what you kind of can tell is we have a potential bearish wedge forming. And usually with that price action like this tends to lead to more downside. So just be careful. If you want to short the yen, at least you have a reference, and that's the key thing. You're at the 50% retracement. Not a lot of volume here, but you can tell. The last time that there was any type of balance before this big breakdown was at where we are currently trading. So just something to keep in mind. Gold continues to hover around these lows here, continues to make lower lows intraday. So I think you stay careful. I remember on the 9th, I bought on GLD Well, at first I was long a put spread on the GLD. Ended up making some money on that. I reversed that put spread. It was the 156 by 154. I reversed it, made it a call spread, 154 by 156. Made a little money on both sides of that trade. Ended up working out nice. Now I'm flat, and seeing where gold goes from here. I'm not saying that it was key breakdown of 1600. I was expecting some type of test of it on Friday. We got, I want to say, up to the mid 1590s, and then fell away from that range. So just something to be aware of. All right, oil continues to drop lower. Now you have to look at it and say, okay, the last time price was here. Every time price has been down at these levels, it's right to be a buyer. I'm not saying that it's like that again this time, but you're probably going to get some type of bounce. And if you do, it's probably going to be good for about $5 or so. Maybe one way to play it, if you don't trade futures, which I suspect many people don't, go with the USO and just go with an easy $1 or $2 spread. Call spread, expiring in a month or so. So say USO stabilizes, oil stabilizes, and starts to trade above 37. Go ahead and buy the 37 by 38 call spread. You'll probably pay about 50 cents for it, which means your risk reward is a 1-to-1, which isn't what it should be. But at the same time, if you limit that downside, if you place your stop at, say, a 30-cent loss, you're risking. Then it turns into more of a 1 to 1.5 risk reward, which is, at least it's more manageable if the trade doesn't work out. But the markets go up, markets go down. USO, oil in general, is probably ready for some type of bounce. Costco, just looking at what we got going on here, we have a big pullback back to the 200-day moving average, where it's been right to buy 3 times, why not 4? Point of control for the year at this 84 level. You keep your stop below 82, and you'll be okay in terms of your risk management. And as far as holding it, I just think you let it do what it's going to do. Not a big dividend payer, but you do get a little bit of price movement, so you can have some capital gains. General Mills, another name that I think could be bought. You're right here off the point of control, off the 200-day. You can see this 50-day came down for a landing and looks to be trying to take off again. Hey, guess what it did last time in the same situation? Came down for a landing and took off again. So I think you can start a position here. Any dip below 39, I think you want to be a buyer. So just be aware of that and see if it can get going. I think that you want to stick with these slow movers, these names that pay 3 to 5% in dividend yields, because I think that's where a lot of money is going to be hiding. And people are looking for yield still, which is why I think in general, with everything that's going on, there's some type of put built into this market. And you'll have your trading opportunities, which you'll make money on, but to park some money in the meantime, these names aren't bad. And I think that one of the strategies that I like to do is taking excess profits and moving them into these slow movers, and then just selling covered calls, cash secured puts, or put spreads on these names to collect some premium and try to enhance my gains on a year-to-year basis. So really, that's all I have to say. I think, still believe there's more potential, more downside there for the market. Don't overexpose yourself to high beta cyclical names. It's not worth it. You can always buy those names if they start moving up. Those are the type of names that can increase in value, 20% on any given month if you time it right. So just be aware of that. And for now, I hope you've caught on to the theme that I've been presenting: slow movers, dividend payers, consumer staples. Even you can look at something like a Duke Energy. Now, utilities, there I have to say that they are at the higher end of the range for their PE multiples. A 5-year range, their PEs say trade between 7 and 20. Well, the majority, if you look at the XLU, which is the utility sector, and you look at those names in that sector, they're all at the very top end. Not all, literally, but I would say 90% of them are at the top end of their 5-year historical PE average, which says to me you can probably get these names cheaper at some point. So if you're looking for yield, maybe buy a fourth of position on utilities and then wait for something to get beat up. So let me conclude to this. I think the potential for more market downsides there. I think we could see the low 1300s without, and I still think that would put the market in a relative range. You'd be looking down to 1300 up to about 1400 or so. I think that would be your given range for the market. Right now we are at this 1340 level, which has been in general the bottom end of the range, and but my belief is I want to be holding more cash because the likelihood of more downside, I think, is pretty high. And if that's the case, I want to be able to be a buyer on the weakness, and that whether that means watching for names to start turning around and then giving us buying opportunities, or maybe the S&P looks to be bottoming and then names start to follow. I don't know which direction it's going to go. Generally speaking, the way I see it is the leaders start to lead and then the rest of the market catches up. So if you see a name like Starbucks start to turn around, this is something that you probably want to be in. Or I guess another one would be Apple. One thing to realize is the price of the price of gasoline is coming down, and what that says to me is people are going to have a little more money to spend. So take it as an opportunity. These names that are starting to get beaten down, that do good when gas is lower, do your homework, find out what those are, and you'll find out that these names will start, catching a bottom, catching a bid, and start turning around. On that turnaround, that's where I want you to be a buyer. So take care, have a good rest of your weekend, and I'll talk to you tomorrow.